Good afternoon, everyone, and welcome to the monthly market monitor for May 8th, 2024. I am Chad Allenberg, Senior Investment Analyst at Corporate Central Credit Union. We'll be going over a lot of slides today, so let's jump right in. Taking a look at the unemployment rate, ticking up a little bit as of late at 3.9%. We're going to take a little bit more in-depth look at some of these numbers. Wisconsin unemployment rate tends to lag behind nationally. As you can see, a pretty significant slope starting in January of this year up to about 3.5%. The U.S. unemployment rate, you can see on the West Coast, Illinois, a couple spots on the East Coast where it's a little bit elevated, but overall, it looks fairly good. Full versus part-time employment. I thought this was important to follow these trends as you see full-time employment kind of cratering, part-time employment is rising. Now, if you look, this is percentage of total employed 16 and over. As we'll look at some graphs later, that 16 to 25-year-old age group has kind of removed themselves from the workforce at a pretty significant rate and been replaced by the 55 and over. So this next graph, which is 25 to 54, and you can see these highlighted areas, those are the summer months. That's when you'd expect an inverse relationship between full and part-time employment. So as summer months approach, people have more time. Some of these people in these age groups are able to work full-time versus part, meaning the kids have childcare, summer camp, whatever. But you can see that overall trend is pretty significant from full-time employment to part-time employment. And as full-time employment has decreased, part-time employment is obviously increasing. Continuing claims, about 1.774, a slight uptick as of late, but relatively flat. Job vacancies. As we look throughout this presentation, you're going to notice, or at least I noticed, that July in 2022 was a pretty significant time period. A few months before and then a few months after, but you can see the number of job openings decreased by 325,000. Reaching the lowest level since February 21. Also, keep in mind some of these job openings that where the decreases were in construction, finance, and insurance. Also, state and local government. You're going to see a huge increase in some of these throughout, but pay attention to that July 2022 time period. It'll be the basis for a lot of the slides we're looking at. Look at the initial jobless claims. Again, if you look at this at a glance, it looks great. It looks relatively flat and stable. Let's take a look inside the numbers. This should jump right out at you. You can see that March 8th through April 12th, you had essentially the same number with one variant, right, on the 29th. This is not only a statistical improbability, it's a statistical impossibility. So I don't know whoever's working for the federal government, if they were on vacation, I forgot to update this information, but we could take this data back as far as we can for initial jobless claims, and you would never see that again. So this raises my suspicion on some of the data that we're receiving. As you can see here, in 2023, 25% of the new jobs were in government. And this is through Yahoo Finance, not what I would call a conservative or right-leaning news source. You can see that 25% of all job gains were attributed to government positions. And 83% of those industries were healthcare, hospitality. Now, keep in mind, some of the job losers were in construction, finance, and insurance. It raises questions about the efficiency and necessity of such expansions, especially when just opposed with layoffs in sectors that are traditionally seen as engines of innovation and economic growth. So what we're going to see throughout this presentation is the G component of GDP, the government spending component, has really taken over spending, transfer payments, hiring, which has been the biggest driver, which normally you'd expect to see during a recession or a severe economic downturn. Government employees, again, that July 22nd or July 2022 timeframe, you can see the slope of hiring significantly increases. And there was a number of reasons for that. A lot of the Corona funds were going to run out at the end of 2023. So you saw a lot of spending going on through the government programs beginning in about mid 2022. this overall slope and the amount of government employees is pretty staggering. Private sector versus government employees, again, we haven't seen this kind of decline in private compensation since the recession in 2008. But during 2008, government employees also slid. Their compensation slid as well. Now you've got this inverse relationship where private compensation is decreasing while public and local government compensation is increasing. Private sector employment, again, looks fairly strong if the numbers are accurate. However, if we look at the next slide, you can see these are the revisions for 2023, and this has continued in 2024. So at only one period had they been revised up, and in December of 2023, they were fairly accurate, but the other 10 months were all revised down, and this trend is continuing into 2024. Now, I've gone back and looked at the data for previous periods, 2022, 2021, and other periods before that, and revisions do happen, and they'll happen in both ways, though. They'll be revised up or they'll be revised down, and sometimes they're not significant. Sometimes they are very significant in the changes. But what I haven't seen is where all of these revisions are down, all in the same place. And to the effect of almost 450,000 jobs in 2023. Purchasing power, this is something we all track. This is your currency expressed in terms of number of goods or services that unit money can buy. You can see on the top graph, unfortunately, I could only find it through 2018, but you can see that your purchasing power has been relatively flat. Also on the bottom one, if we look at the CPI, and this is for urban consumers, you can see that significant drop since the pandemic in urban purchasing power, which dovetails nicely into the next one. CPI for all consumers. Again, the consumer as your prices are rising, your purchasing power is decreasing. However, the previous graph with a little bit greater slope than this, but it really shows some of the challenges in living in an urban area, along with crime, homelessness, taxes, education. But really, the people living in larger cities are really taking a beating right now. The SOMRO, we discussed this last time. This discusses the probability of being in a recession. I don't want to go into too much detail, but as of last time, it's gotten a bit worse, and you can see that according to the SOMRO, it suggested that a recession has already started. If you look at some of the information before us, very skeptical of some of the job numbers, it might be entirely true. Temporary employment, this is also a leading indicator. Again, if you look around that July of 2022 timeframe, it's not a perfect correlation. I'll admit that. But if you look, temporary employment, generally those are some of the first jobs to go. And you can see this is definitely, this slope of this decline is pretty precipitous. Here's another one, is the permanent job losers. Again, right around that July 2022 period, and not perfect, but you can see that those permanent job losses, trucker jobs, and then the number of openings. So these are permanent job losers is rising at a rate that only has been seen previously in recessions. And this brings me to something that I discussed with several people here at Corporate Central, is that if you would look around that July, the June timeframe, right at the end of July, that would have been our third rate hike. However, you had this conflict between fiscal policy and monetary policy. Obviously, fiscal policy, that's what we're going to get out of spending out of Congress. Monetary policy, that's the Fed. So you've got fiscal policy that is immediate, although difficult to enact, right? Try to get Congress to do something. While monetary policy is easy to enact, but tries to change behavior over time. So as we've looked at these graphs, we've looked at the trends of unemployment. We looked at the trends in permanent job losses. You can make a strong argument that had the G component, the spending component of government, just not spent as much, many of these rate increases would not have been necessary. The unemployment rate, again, this is the U6, marginally and partially attached. You can see that this has been heading up too for some time. Labor participation rate, and although it doesn't seem like a big deal, when you've got 350 million people, and at one point you had 63.4 pre-pandemic and 62.7, That accounts for a lot of the people who aren't currently in the workforce. As we looked at those numbers previously, you had to wonder where these people had gone. A lot of them are just no longer in the workforce. Multiple job holders. I thought this was pretty staggering, along with that time period we had identified earlier. These are multiple job holders, primary and secondary, who are both working full time. This is a significant amount. I'm sure it speaks to the inflation that we're all seeing and feeling, but it's pretty staggering to think about all these people working two full-time jobs. U.S. retail sales, again, relatively strong for March. The trade gap. So the trade gap, again, is moving its way back down. You can see we never recovered from the trade imbalance pre-pandemic. Some of the some of the some of the policies of former President Trump, some of the sanction he placed against China seem to be having an effect, reducing that trade gap a little bit. But you can see since then, since the pandemic, it's pretty much blown back out. Personal savings rate, again, with everything we've seen, and obviously being in the credit union world, uh, understanding how hard inflation, household expenses, other expenses, and we'll look at some graphs later, but you can see 3.2% current versus about 7% pre-pandemic. So less than half the savings rate. Household debt. And this is really significant. You can read this yourself. This is through 2023 fourth quarter, but 12.25 trillion at the end of December. Home equity lines, HELOC, increased by 11 billion. Seven quarterly increases. 360 billion aggregate outstanding balances. Credit card balances now at 1.13 trillion, increased by 50 billion. Auto loan increased by 12 billion. The only thing that stayed relatively flat were student loan balances, and non-housing balances grew by 89 billion. GDP growth, again, 3% for an economy this size is considered strong GDP growth. But as we looked at earlier, the main component of this is government spending, which during an economic downturn, during a recession, isn't necessarily bad. However, when you have the debt and deficit that we currently have, we're just piling on debt and more debt and more debt. Annual growth rate over 10 years showing us the same data. A GDP forecast. This was as late September of 2023. It's hard to find some updated graphs, but you can see in Q1, we certainly surpassed the forecast. We'll have to see how this turns. U.S. debt to GDP. So we currently sit at 121.6%, which is in itself terrible. But if you look at this overall trend, some of the information that we had shown earlier about the amount of government spending and transfer payments, we're going to look at in a little bit. Government hiring, we're reaching pandemic levels without a pandemic. So it's really a staggering and sobering graph to look at. Government spending to GDP, as you can see, was listed at 37% at the end of 2023. 37%. The average was 25.66 until 2022. So we're running well ahead of government spending to GDP where we've ever been historically, and we're ramping up with additional government spending. Budget by outlook. This is the CBO's numbers that aren't necessarily all that accurate. If you look at 2023, about a $1.3 trillion deficit. This is just the deficit. This isn't the overall debt. We're actually adding about $1 trillion to the deficit every 100 days. So not only is it increasing, there's a multiplier effect going on for the amount of debt that we're rolling up in this country. Housing starts with the loss of those construction guys that we looked at earlier. Remember, those were some of the job losses in finance and insurance. This is the expectation. So you're seeing fewer houses built. Existing home sales did kick up a little bit. You do expect that as you come out of those winter months, people start buying again. However, you can see the trend down. The home price of a median home in this country, nearly $400,000. Gone are the days of the starter home for 150, 120,000. Now, on the West Coast, that's obviously where you get a $1,200 square, 1,200 square foot house for 1.1 million. This doesn't necessarily reflect that in the Midwest or the South or other places, but still, overall, nearly $400,000 the median price. 30-year prime fixed at 6.61. MBA refinance, again, this is going to be death, divorce, and dislocation. You can see it ticked up a little bit early in this year from where it'd been. It'd be my suspicion that there was a lot of people holding on early or late in 2023, early in 2024, hoping interest rates would go down, and that just didn't happen. Annual inflation rate. This is pretty staggering too. You can see over the last 3 months, it's not necessarily going down, but it's actually increasing. This is the highest since September. Really, as you look at all these energy costs, gasoline, utility services, your food, shelter at 5.7%. The only good news is used cars and trucks are going down. We're seeing a glut of new and used vehicles. You see the fields full of Chinese EV imports now, as China is trying to corner the electric market. But this inflation rate really speaks to why the savings rate is currently so low and all the household debt that we're seeing. Core inflation rate, again, core less food and energy. This is the government's way of massaging. This is their preferred metric. However, it's still above all inflation items. So even stripping out food and energy, you can see that it's at 3.8%. Also, this is pretty staggering too. If you look at wages versus inflation, as wages have moved down, inflation's been relatively flat or increasing. As we said over the last 3 months, it has been ticking up, even taking a bigger bite out of your purchasing power. Annual inflation rate. This is a bit busy, but this does show you all the different economic crises that we've been through and where the inflation rate has been. And you can see since the pandemic, with all these other economic crises, it usually settled back into what we consider a normal range. That hasn't happened. That has remained elevated due to that G component of government that we saw earlier, spending and hiring. The PPI. If you want to see where the CPI is going to go, look at the PPI. The last time we talked in December, I said not only is the PPI high, but it's also sticky. And you can see that here. A lot of this has to do with the regulations. It's been a different attitude towards regulations on the Obama administration versus the Trump administration. But because of that, because of the prices, you can't expect consumer prices to go down anytime soon with this high of a PPI currently, which is sticky and is rising. Oil reserves, again, oil's been relatively tame so far, but it's extremely volatile. We've got a lot of Venezuelan oil, still a lot of Russian oil, a lot of Iranian oil, a lot of people who aren't our friends who are in OPEC plus who or whatever they have now. But oil tends to be very, very dynamic and very explosive. So it's always something to watch, but currently it's relatively low. Taking a look at the WIRP again, earlier in the year, late 2023, they were talking about 6 possible cuts. You can see there's a 51% consensus in September, 55 in December. These are very fluid. If I'd run the WIRP now, it might be slightly different. Depending on economic news, you can see some really significant changes. But this is where we currently stand with not much of a consensus in September. 51 is certainly not overwhelming, nor is 55. Normally, when you see a consensus, you'd be looking at 80% or greater, something within those lines. Of the yield curve, obviously, you can see the changes from 5 years ago of the 3-month 296 up to the 30-year to 167. Yield curve year after year. Again, you can see at the beginning of last year, or throughout the year, there was some hope of interest rate cuts. However, it's looking like higher for longer, as the Fed has talked about, is going to be the rule. And the yield curve month over month, again, some change after the economic news that came out with inflation being sticky and rising. The 3-month Treasury, 5.48 and rising. 12-month Treasury, with some economic news that came out in the last couple of days, you can see a bit of a cut, but overall, that overall trend is rising. Same thing with the 3-year. The reason I'm going through these slides, and I'll go through a little bit quicker here, the SOFR rate, again, flat, 1-month SOFR, is that when the Fed moves, you're going to expect changes in the 90-day first and the 30-day second. That 90-day is going to move down to the prospective expected rate that the Fed has. Generally, the Feds don't like to shock the market. So if there was going to be a move in the within the next 90 days, you'd expect to see it is 3-month term SOFR, which is more of a forward-looking metric versus 3-month average. So if they expected changes in the next 3 months, we'd expect this to start moving down, but we just haven't seen that. As you can see here, it's been relatively sticky, relatively flat. So no signaling on the curve that there's going to be a rate cut, nor the work. Taking a look at the year ahead quickly, commercial real estate. This is something we talked about in December. However, as bad as office real estate is, retail real estate is just as bad at this point. You can read here that 41% community of losses and distress, really troubling sometimes. You're looking at 234.6 billion at year end. Something else to keep in mind is you'll hear a lot of people talking about converting office buildings or retail buildings to apartments. If you have family or relatives who work in the trades, plumbers, electricians, carpenters, they'll tell you just how difficult it is to convert an office building to apartment buildings. Unless you're going to do a European style, almost college-like dorm where you've got one bathroom, community bathroom, the electricity, the outlets, the plumbing, the HVAC guys, they're going to tell you how it's a bit of a pipe dream to think that you can just convert these buildings. And the same thing's going to go with some of this retail space. So what to do with it, what to do with this time bomb that is rapidly approaching, will be interesting. Another thing is phantom debt that I came across. I think we've all seen this on Amazon or whatever our preferred online shopping is. And this is where, 4 payments of $200. Well, as you can see, this market has grown each year and is projectedly 700 billion by 2028. So not only is it a significant amount of money, but if you look at this poll, 43% of those who owe money to these services were behind on payments. And 28% said that they were delinquent on other debt spending because of the platforms. So this is important because there isn't a whole lot of disclosure on this. So as you're extending loans, liquidity, credit, some of your members, you don't know how many outstanding loans that they have through some of these platforms, the buy now, play laters. But it's going to become a significant issue, which also ties into the savings rate of 3.2%, where Americans are just tapped out. Unemployment rate by age. As I had earlier scrubbed the 16 to 24, you can see why. And I did look and tried to find 2023 data. However, I was unable to. But it's my belief as you look at this, that this trend is going to continue, where the 16 to 24s have left the workplace from 60%, almost more than 20% current, and the 55 and over, for obviously economic reasons, have re-entered the workplace or just not left the workplace. But as people have thought about how much the boomers had been leaving, you can see that overall trend is not that people over 55 are leaving the workplace, it's that they're staying in the workplace. You'd also expect this with work from home, maybe prolonging somebody's occupation, or maybe before they would have chosen to retire. But I'd expect this to have crossed at this point in 2023 with a greater percentage of 55 and over in the workplace and 16 to 24 less in the workplace. Cost of debt, I mean, we've been talking about this for the last 25 minutes. You can see that debt is just surging, and it's going to become the largest part of our fiscal budget in the next few years. And here you go. This is a great graph. You can see currently we're about even with 121 debt to GDP ratio. It will become the highest spending bucket that our government doles out. Greater than education, greater than defense, greater than anything else would just be interest on the debt. And remember that when we were rolling over debt at lower interest rates, it was much more manageable than what we're paying now. The federal deficit, again, this is just the deficit and not the total debt, 1.7 trillion. And the federal deficit trends, as you can see, the steepness of this red line, I'd actually expect that slope to get a little bit steeper compared to what it is here with all the spending and adding nearly $1 trillion in debt every 100 days. And transfer payments, this is something I think very important to look at. And again, this ties into that same time frame we've been talking about, that around mid-2022. And as you can see, government transfer payments have significantly increased, especially the fourth quarter of 2023. So we're really seeing some steep rises. And what we're heading towards is the transfer payments that haven't been seen in nearly any economic downturn, with the exception of perhaps what we witnessed during the coronavirus. But at least there was a reason for it. Now it's just additional spending. 4.2 trillion in Q1 2024 alone. If you really want to be depressed, take a look at the U.S. debt clock. As you can see, the national debt, 34.7 trillion. I mean, that's Death Star money right there. You could probably build 2 or 3 of those. The debt per taxpayer, 266,000, 103,000 per U.S. citizen. It's just staggering when you really look at this. And then the revenue per U.S. citizen is about 14.3 thousand. So obviously the government's spending too much. It seems that if you would have gotten fiscal and monetary policy working together in conjunction instead of against each other, a number of these interest rate hikes wouldn't have been necessary, and we could have prevented or at least slowed the increase of inflation. So we're taking a look at all these periods. Again, as we talked about before, when things go bad, they go bad quickly. Generally, data is lagging, however, sentiment will lead. And Americans are very pessimistic at this point. And looking back at some of the former graphs that we looked at it with temporary and permanent job losses, purchasing power, you understand why. Bankruptcy filings, more bankruptcy filings than during the COVID lockdown since 2000 and 2008. This is really a significant amount. When we talk about the job losses that we saw too, finance and construction. Taking a look at the Fed meeting dates, again, as we talked about a little bit earlier, when you look at the 90-day term SOFR, it doesn't seem to be signaling, nor does the WIRP, any cut within the next 90 days. So that would exclude June and July. So you'd be looking at September and 18th. Again, not strong consensus for that, but expect to hear something out of the Fed during the June and July meetings, which could definitely start to change those metrics. That's all I have for you today. I'll open it up to any questions. With no questions, if you're shy or would like to see where I found some of this data or concerned about some of my analysis, I can be reached at chad.allenberg@corpcu.com. I thank you for your time and have a great Memorial Day at Month End. Thank you.